Good morning, everybody. Welcome to the Flow Show. Hope you're all doing well this morning, surviving after the Nvidia carnage last night. Bit of a damp squib in the end. Bit of decent price moves, obviously, but yeah, not exactly the biggest thing since the last FOMC anyway, or big meetings like that. Kay, did you contain your excitement last night?
Good morning, Ryan. Good morning, everybody. It was, well, for me, it was a glass of wine and popcorn, mate. I haven't done anything on the back of it. Just watching the game, having a glass.
Yeah, well,
But
good mate.
yeah, it's how shall I say? It's perhaps not the reaction that some may have expected in the market, because some were saying that, right, Nvidia is going to be that last spike, and then the whole thing, well, not the whole cart house will fall apart, but we are going to come to more reasonable levels, but nothing of the likes. The equity markets are very, very buoyant.
Yeah, very much so. It's one of those weird situations. Was the market, as I said on F.A.C.E yesterday, just selling off a bit in stocks, just taking some risk off the table in case it was a bad number, and then everyone piled in again? It smells like that. The interesting thing is, as I've been mentioning this week, what S&P does, or for my interest anyway, what S&P does after those numbers will be key. At the moment, it's nestling up into these high areas, but it's not getting through just yet. So that'll be one of the important things to watch when the US odds come to town. Will they take this off through 50-50? Or is there going to be a bit more of a solid top coming into play? If it goes through 50-50, I think we're off to the races again. If it doesn't hold, we'll probably see a few sellers coming in, and then all the top pickers will come out in force again. We'll probably get a deeper drop.
Yeah.
We'll see.
The market may be, again, as you say, a bit cleaner now, because there was a lot, a really big amount options plays on what Nvidia may come out with. But perhaps now that is out of the way, perhaps most of them have been either washed out or profits taken, or options perhaps coming to expiry today, actually. So today may be a bit of a wild ride as well. But then the market should be, in theory, a bit cleaner again, right? And then we will see exactly what Nasdaq wants to do, what the S&P wants to do on the back of it as well.
Yeah, exactly. Right. Just quickly before we get stuck into things, want to just look back at all the people who left their comments. So just looking back at, I said, will it be above 700 or below 600? Nashi said below. He was wrong on that one. Gavin says he's going to fill the gap to 320. I'll take that as a joke. Gordon, you might get your $1,000 a share. You were saying yesterday, but Gavin said under. Ali, what were you saying? You were saying above 7. Brand said under. Lucas, it was below. So yeah, a lot of people were a little mixed now. Some above, some below. So those of you who got it right, well done. Those of you who got it wrong, must try harder.
It's well above.
Anyway, what?
It's well above.
Yeah, it's well above.
Like 770 or so right now.
Yeah. It gives that pre-market on the screen. Yeah, you said it was going to be at 7. So, yeah.
Yeah. I've got the big figure right.
Right, let's get into the rest of it and see what's going on in the world. China Foreign Minister Wang Yi has promised to Europe that China will continue to keep opening its market. The question remains whether anyone's interested in stepping back into Chinese market. At the moment, that seems not to be the case. Over in Japan, we've had some more wage news out. We got all that, the automakers yesterday, Honda, Mazda. Well, Aeon, which is a big retailer, has apparently fully met the union demands for 6 of its subsidiaries. And they've reached a deal about a week earlier than they have last year. So a lot of emphasis there, a lot of eagerness on these wage talks. They say the wages for full-time workers at its core retail unit will rise 6.4%. That's above last year's 5%. Part-timers will also receive a previously promised 7%. Matsuya Food Holdings as well. They've hiked their wages to 10.9%. Its largest increase since 2001. So these wage numbers are, on the whole, coming in pretty much on the high side, pretty toppy for these. So it's going to be good news for the government and therefore likely the BOJ too. Economists still putting their forecasts in, various news wires taking lots of polls and whatever. 80% of economists say the BOJ will scrap negative rates in April. So that's when they're circling the calendar for those guys. For the BOJ, Ueda said that Japan is experiencing inflation. Says service prices have continued to rise gradually. Says the BOJ looks at price trends for policy decision. And reading from the government hymn sheet, says it expects the virtuous economic cycle to strengthen. Sees companies becoming more active on wage hikes, which, as we can tell in these early days, they are. Finance Minister Suzuki says there is no defence line in FX. They haven't got a number, but they are still talking pretty strongly. And when asked about it, said that we need to focus on volatility or fluctuations. So again, that are these moves that we're seeing volatile? At the moment, we've been glued in around about 150 for the last few days. So there's nothing in those moves to get them hovering their finger over the trigger. But they are keeping the rhetoric pretty strong still, despite all that. Looking at the data, PMI stuff out and about. Australia PMI coming in better on services, moving into expansion, a bit of a theme we're seeing today. But manufacturing going the other way, so still a bit soggy there. Also Japan PMI, manufacturing looking a little bit worse, services coming off a bit, 52.5 versus 53.1 previously, but still positive. So on that front, not looking too bad there. There were some department store sale numbers out from Japan as well. Nationwide department sales year on year up 7.1%, higher than the prior 5.4%. And for standalone Tokyo, store sales were up 6.7% versus 6.2% prior. So some fairly decent looking numbers on the retail front from the big department store sales. Kate, this it's a bit of a mixed picture. You either sounded fairly bullish, you're sort of brushing under the rug of the recent softening data that we've seen and that dipping in inflation. It seems to be all action, all lights green for maybe this season.
I'd say so too. He was right in expecting CPI to come down the second half of the fiscal year, and but he's also saying that they will stay in inflation. He must like what's happening on the Nikkei front, on the JGB front being very, very quiet. It's all playing, and then wage negotiations seem to go the right way, and so yeah, for him it's still a green light. Now I've seen an ex BOJ coming in and saying that they may even move in March. You know, I wouldn't totally dismiss it, but base case will still be April. Wait until the new fiscal year goes underway. But yeah, he's still pretty good. I found Suzuki's comments a bit. I don't know whether he didn't expect the question also in the diet, but a bit of a half a step back compared to they're keeping the high sense of urgency in there. But perhaps he got a bit of assurance from Ueda then saying that that they will go on with what they plan to do. The thing is still though is that if you don't only look at dollar yen, but if you look at all those yen crosses, they are still so big. And
Well, that's the question I was going to ask you, the trillion yen question. You know, we have these strong wage numbers dropping
yeah,
down. We have Reader talking fairly positively. We have this increased rhetoric from the Ministry of Finance about what's going on in the yen, and it's not reacting.
no, and in surplus we have two areas of big investments, one in Hokkaido and one in the south, and the market is absolutely not reacting to any of it. That is, you know what? Well, and it's actually on the contrary. The market is completely back onto the higher equities is lower equals lower yen boat.
Is it wrong? Because if there's all this money flooding into Japan, like you say, you've got these big plants opening up. You've got the diversification away from China. You'd think yen would be gaining on this, but
Timing. I
it
think it's
seems.
all about timing. But I also said in the room this morning, I am finding this correlation between equities and the yen. We're back on that train, and of course, if you look at interest rates, they're back higher, right? We had those PMIs in Euroland. We had also PMIs holding up in the UK. You see all those crosses higher. The commodity yen crosses higher. There is some logic, but now really, and you know what, the month end could actually even be more damaging for the yen, because if this correlation is really there between equities and FX, I would say we could still see more yen selling into month end. But I'm starting to find it all a bit fast. It's hard to say it's overdone, because if they don't intervene, the weak side is still for the weaker yen, because the interest rate differential is so simple, and that correlation between equities and so the market is not going to let go of this. They really have like a big bone that they are chewing on right now. But I'm looking forward perhaps a week or so. I'm really curious what the reaction is going to be when we start March. And timing is perhaps not great right now, but just for the perhaps shorter term or medium term, I am looking at stuff where if they really go for blow off top moves in all those yen crosses to see if there's not a bit of a just a tactical reaction, you know, coming March. And yeah, I'm thinking about Swiss yen in a way. But just to come back to your question, I start to find it a bit rapid, all these moves.
Yeah, very much so.
Just based on the fundamentals. Yeah.
Yeah, it's as I mentioned, it's the whole picture is looking a bit risk on. You know, commodities up, currencies up. You know, dollars softening a bit as it tends to do, but there's a lot of drag from the yen crosses. You know, when you see all the yen crosses rising quite strongly and it dollar yen's doing nothing, that's when you know that there's a bit of a mix on going in play. So yeah, it's a bit of a funky time for me. As I said, there's lots of plates spinning in the air, and there's no one clear driver of anything at the moment.
No. And I'm still a yen bear at heart, but in the long term, but in the short term, I mean, I can't go and chase these moves. This is starting to look a bit speedy for me.
Yeah, exactly. In particular with this uptick in rhetoric from the Ministry of Finance, being long yen pairs is maybe a little bit more dangerous at the moment. But anyway, it takes two to make a market, and there's plenty there for everyone, and we'll have a look, more detailed look at the prices in a moment. Coming back to the calendar, just going through all the other PMIs and whatnot in Europe, France, with some positivity on both manufacturing and services, all improving there, although we're still in that contraction setting. Germany as well. Well, had an improvement on services, but manufacturing absolutely fell dead on its face again. So that's not looking good for the big growth engine over there. So that let the side down really. Because the rest of it, we had some Italian CPI numbers. CPI looking sticky, and then the HICP measure as well coming in as expected, but a rise over last month. So sticky numbers there that have been falling quite nicely. The Eurozone overall index there, services moving into expansion just about, well, sitting on the fence really. 50 print there for that. Manufacturing though, likely Germany, the big driver behind that, dipping back a bit. The UK too, an improvement on manufacturing. It missed expectations, but it did go up a pip over last month. Services stayed unchanged, was expected to come down a pip, but that's good news in itself because it's maintaining the gains we saw last month. So that further improves the likelihood that the Q4 data falling into recession might have been just a little bit of a blip, and that will reverse in Q1. We'll have to see whether the consumer helps with that or not. It could be a bit of a maker or breaker. Final CPI numbers from the Eurozone were all unchanged, 3.3%, confirming the pip drop in the core, and 2.8% unchanged over the flash number, again confirming a pip down over last month, but still well above ECB's target. Back to the Bank of England, or over to the Bank of England. Archdove Dingwa the Dove, said monetary policy needs to be forward-looking because moderation of the policy stance requires time to implement and feed through to the real economy. That's her saying why she wants cuts now, because it takes a while for that to be seen in the economy. And she said that the evidence to err on the side of over-tightening is not compelling, as it often comes with hard landings and scarring of supply capacity. It says we have a long way to go before coming to a finely tuned estimate of the medium-term resting place for the bank rate. That's a long-winded way of saying I don't know where their neutral rate is going to be yet. BOE Green says a tick up in the PMI data offers some grounds for optimism on growth in 2024. Says wage growth is heading in the right direction, i.e. down. Says services inflation is generally starting to ease. Over in the ECB's Wunsch says it may be too early to get hopes up regarding rates, talking about cuts. It was funny because after the France PMI, traders cut their thoughts for ECB cuts this year to less than 100 basis points. Then we got those German numbers, and as I mused in the room, they probably started pricing QE after that. But still, we're seeing a bit of a drawdown in rate expectations still. Again, another reason why pairs like the euro are looking a bit buoyant. We've had a reprice of the Fed dovishness. Now we're going to the reprice of everyone else because things aren't falling off a cliff and prices remaining sticky. Fed's Barkin was out yesterday saying that the big picture of US data on inflation and jobs has been remarkable. It says recent data on PPI and CPI have been less good, and it's showing a dependence on the need for disinflation on goods. It says January's data made things harder, but should not put much weight on 1 month's information, given its seasonal issues. It says interest rate sensitive sectors are struggling, but people still have money to spend on services and experiences. It says the US is on the back end of its inflation problem, but the question is now, how much longer will it take? Fed's Bowman says the time for lower rates is certainly not now. That's it from me on the headline front. Kay, anything from you?
I think we've covered most of it. There's not a lot to discuss more. The rest is all opinion pieces, mate. And there's I think we're waiting for the US CPI to undo what we've done this morning, perhaps. If that comes out better than expected, maybe. So we will see what's happening for the rest of the day, and especially looking what's going to happen on those with those equity markets, because they are going to be the driver this afternoon again. Everybody's going to look at those. No, I don't have much more to talk about on the data on news front.
Cool. Yeah, as you can see there, we've got jobless claims as usual. Retail sales from Canada for December. Keep an eye on that one. Expected to post a decent bounce over last month's bit of a horror story there. And then we got those S&P US manufacturing and services PMI flash numbers coming as well. So a bit of data to get our teeth stuck into. Ali asks, what about today's UK data in terms of euro sterling? Can the euro lead? Because the data is not very welcoming for the BOE. In what sense is it not welcome for the BOE? It's positive data, which is what they want. No one wants a recession. I think largely because it was so unchanged and there was a bit of improvement in Europe, it's largely neutral in terms of euro sterling. Obviously, the price isn't doing an awful lot. 46.75 the range, so 30 pips we're in at the moment. So it's not showing favoritism one way or another. If Europe picks up more significantly, if we start seeing all those numbers turn positive, then the euro will probably start firming up a bit more against the sterling, I should think. But how far, I'm not too sure. I don't think we're going all the way back to 87, 88 just yet, unless something goes really wrong with the UK. But yeah, I think we're just we're middle ground for that one for euro sterling at the moment. We'll have a quick. I'll stick it on the chart quickly just to have a quick butchers. Come down to, let's have a look at the hourly. So as you can see, still trying to get through this 70 area. It's just opening up a bit. So we're still walking old levels, walking old ground until we actually get a move above 85.70 and hold it. I'm not thinking about anything else. It still keeps the downside in touching distance, so we can't rule that out still. But yeah, we're not going down anymore, so that's step one. But can we start moving up? Euro dollar, we were moving up. Managed to get up above this zone, break through it. We had a little bit of trouble yesterday. Now we got through it, but again, it's running out of puff a bit. Just tick the above the 38.2 fib of the year's drop, but I want to see it holding this 108.30 area on a dip. Now, if we hold that, then yeah, it's going to keep the momentum going from here. And do that, then maybe we go and have a look at 109. But again, I'm not expecting any rockets going on here. I think a lot of this is a bit of risk on, a bit of repricing for central banks, the end of repricing for the Fed, the market a bit more in balance with what it expects from the Fed. So, yeah, I see this right now. I see there's nothing more that maybe, and maybe having a mooch to the other side of the range. So up at 109s, I know there's going to be a lot of people getting tempted if we get up there. But again, as I mentioned in the room, when we were coming down here and coming down to 107, everyone was talking about, or lots of people talking about, 105's next. Here we go, 105. We haven't gone there. I'm going to expect the same on the upside. If we get up a bit further to 109, people will be going, can this go all the way back up to 111, 112, blah, 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 blah. It could do, but I'm not expecting it. I expect us to still stay in this pretty tight range. There's nothing in the fundamentals, nothing from any central bank that suggests that euro dollar needs to move anywhere new or significantly in the next few weeks. What I'll be guided by is what happens with the levels. So if it starts breaking up through all these levels, then maybe it's a different story. But for now, I'm not expecting it. This is just mooching around. But while it is mooching around, I'm happy that it's going up. I've been slicing my longs from 107 a bit more up here. So, yeah, I'm happy if it does go up. So even if I would like it to go to 112 because of my position, I don't expect it to do something like that. So I like to be objective when I'm looking at my trades. On what can go wrong rather than what can go right. What do you make about this one, Kay? Euro dollar
109, there you go, 109.17, the 50% of what we did since the start of the year. That is the level that I'm looking at. Really, there's a few in between levels in the 90s, bottom of the daily cloud in the 108.98 zone. But you know, the clouds haven't really told us too much in a euro dollar at least. Sorry, on the daily, that is. It's yeah, to me, as you say, man, it's just we're in a range. We're in a range right now. We have seen the dollar strength, the dollar clawing back from what it lost at the end of the year. We've seen this move lower. We've seen now it's converging towards the midpoint of all of that, and that is sort of what I was expecting as well that would happen, and we see it in quite a few currencies. And well, barring the yen, of course, that the yen is always a different story. But yeah, that's where we are, and now we're going to go. What's next? It's still all fits in what I'm expecting that is happening in the more medium term. That is that first quarter, we're going to be doing this. Dollar getting back, then we stabilize, then we wait for what's going to happen. I think really my view is unchanged. I think Q2 and even the latter part of Q2 perhaps is going to be where a lot can happen, and hopefully ranges break and we will have a real trend to trade. Until then, I expect, or let's say my base case is still that we are going to continue to trade these ranges for now.
Yeah, I agree that. I agree that as well. We are, when you're looking at the fundamentals, they do form a big part of the picture, and obviously central bank expectations. Again, central bank expectations are for rate cuts, but we're not talking hundreds of basis points of cuts. We're talking maybe 150, 200 tops in the whole cycle, and that's not even for all the central banks. Someone like the ECB, maybe 100, 125, something like that, before they decide that's where they want to settle. So when banks do start cutting, if they start cutting, it's not going to be huge moves. So we're not going to be seeing the type of thing that we saw when everyone got on the hike cycle and went from 0 all the way up to 4 or 5%. So you've got to keep context in mind when you're trading this. So at the moment, I don't see huge range changes coming. Yeah, we might stroll up to the high point in euro dollar. We might have a mooch back down to the low point, but I really, for now, I just don't see us going anywhere new. But there's plenty of room for you and I to trade in. So yeah, pick your levels, pick your points. If they hold, you know what to do there. If they break, you also know what to do there. Gavin says euro needs to get above that 108.95 area. Yeah, we'll call it the big figure. I'm not going to argue over 5 pips. So yeah, pretty much right in there. So let's just get rid of the cloudy for a minute. So yeah, round about there, 109, 109.20, whatever you want to call it. It's a bit of a pivot area, a bit of a, you know, it holds it support, it's resistance, support, resistance. So yeah, a bit of a pivot point up around that 109 zone. Agree with that, Gavin. So as I said, dollar yen, not doing naffle at the moment. One question I've got for you, Kate, just going back to the BOJ. What happens to the majors if we get confirmation that they're finally ending easing, going to hike rates and whatnot? If we see the yen go bid, what's that going to do with the majors? Are we going to see the majors falling in sympathy with it, or being dragged down by the yen moves, or will they go the other way on the back of the dollar?
Well, if you look at the investments, what the Japanese whales are doing, right? The investments, and can I mention the interview yesterday, Ryan?
Yeah, go ahead, mate.
Yeah, all
Yeah,
right.
put it
So
up, put the link in.
huh?
Put the link in the chat as well.
Okay. Yesterday I had an interview, and the first one that I did on Trader Summit with Blake, and we were talking about the mechanics. I was talking about the mechanics at one stage during that interview what may happen. So we have to understand the Japanese whales, they are mostly invested in outside of Japan. They are mostly invested in dollars, right? But they have a part in euro, and then they will have parts in Aussie, for instance, small bits and bobs in sterling as well. So it's a little bit like how a central bank would have their FX reserves in one or the other currencies. So there's a grading, but the bulk of it is still in dollars. So the mechanical thing of it is that they would probably move out a little bit of investments abroad and go back into yen bonds. This is what they told us already at the end of last year, right? So meaning is that when they buy foreign bonds, they usually buy dollar yen bits of dollar yen. It depends how much they want to go hedged or unhedged. But I would say that mechanically, yen should strengthen versus stuff like dollar, bit euro, a bit of Aussie, a bit of sterling. That could mechanically have a little bit of an impact to bring those currencies actually lower. And a lot is going to happen via cross yen again. So to see what really happens to a pair like the euro dollar, that's going to be a very good question. If you look at the size of investments, and if you look at the equal percentages being repatriated, for instance, that should actually be a bit for the euro dollar, because they are going to repatriate more out of the US than they repatriate out of Europe perhaps. So that could be, in a way, weighing a little bit on the dollar pairs European side, and perhaps weigh a bit on stuff like Aussie, for instance. There's also the expectations that it should weigh on the Nikkei, but that yesterday as well I spoke about it. It's very unclear to me, because the fact of repatriating as well, if they need to repatriate a lot, that's the next question, right? They're also going to go back in their own markets, so they may up their yen holdings, and that may actually have much less of an impact on a Nikkei, for instance, than it may have on bonds. That is my opinion. So I'd say mechanically yen should strengthen at first, because they told us they are waiting for the Bank of Japan to hike rates to go back deeper into JGBs. We will have to look at what that JGB thing does, because it's been extremely stable right now. 10-year JGBs is turning around 72 BPs, and then in a second leg, then we will have to wait and see how far and how speedy the Bank of Japan will need to go, or can go. Okay, because if they take us out of the zero interest rate policy, and then it will really depend on how big the window is still open, or how fast it's closing. I'm thinking about inflation, but not only inflation. They have to get out of that negative GDP as well that we saw, right? So we've got a lot of mixed signals there, and hopefully for them, they can take it at least to a quarter or a 0.5% positive. But then again, we're talking about Japan, and my base case is then the party will be over, and by the time we get there, we will have to see what the rest of the central banks have to do, and that will direct the mechanic moves that we will see. And there, my base case is that at the end of the road, Bank of Japan is still going to be well below others. And I think the strengthening of the yen may be only temporary, and then I'm perhaps a few months or so. And that is how I see it. Now, to read the other currency pairs is going to be, but it's likely going to be a bit difficult,
Yeah, it's a bit wait and see. But
we will have to see exactly what's happening.
Yeah, the main point for us that trying to put forward here is that this BOJ thing is going to be big potatoes, and it's going to affect all FX markets, not just the yen. So, you know, if you are in other pairs, you need to keep an eye on what goes on here, because this is one of those generational moments potentially, and it's going to have a big impact initially on all FX pairs before the dust settles and we know what to do with it after that. So even if you've never traded the yen in your life, you need to keep an eye on it, because it's going to affect everything else.
Yeah, and you know what? It could have actually for speculators then, and I'm not talking about the mechanics of what the Japanese investors will have to do, or foreign investors into Japan. Because we have seen a big investment spree into Japanese assets, right? And we will have to see what those mechanics will have to what they want to do with it, because that also is going to drive currency pairs. Imagine that the big US funds say like, yeah, I like very much what I'm seeing in Japan. That will put extra pressure on the dollar yen to the downside probably. Although so far they have rather been borrowing the yen and then buy Japanese assets. So those kind of flows we will need to see as well what they want to do with it. So it's really going to affect all markets, and then the speculators. Well, we can also, because the speculators, they have had 1 round, 2 rounds where we saw dollar yen come down last year on the expectations of, but they have not had like a very big round, because rather quickly the move turned around. Not for us day-to-day traders, there's still been big moves, but for those guys who want to stay weeks or months in positions, they did not have that much time to stick into positions, because it reversed quite quickly. But we will have to see what the speculators as well want to do, because then I'm thinking about something like, for instance, Swiss yen, where SNB could be on the verge of letting yields or rates slip just a little bit, and then with the Bank of Japan hiking, that could be one of those pairs where the speculators put really their teeth in and send a fair leg lower, and that's on the side of whatever mechanical flows can derive from Bank of Japan moving.
Yeah, thank you, mate. And yeah, that was a bit of a leading question for Kay to put his link up, so have a look at that. Kay doing an interview with Blake on Traders Summit there, talking about yen and the Swissy. So it's a good watch. Make sure you grab that link. Don't watch it now because we've still got the show going. But after the show, it's worth having a look at. Yeah, thanks for that, Gavin. Berkshire have got their results out Saturday. Could be an interesting watch to see what's going on with their Japanese holdings. One of the early movers into Japan. When they're in, then they tell us they're in, and everyone runs to play catch up. So yeah, we could get some comments out of that. Japan might become the new China at this rate. Lots of investment going on, could be work wonders for them, and getting out of this slump they've been in for so long. Right, looking around some of the other grounds. Let's just bring that down a bit first. Let's go to an hourly. US bonds, US 10s, yields have been ticking back up again. We're back into the 430s, finding a bit of a top though, around 433, still holding this 420 area. So it's keeping this move going that we've seen since February. But as you can see, it's not really having much effect on dollar yen, at least. That's just caught in the cross currents of everything else. But the market not really giving up what it's had, keeping the 2-year round about where the Fed expects rate cuts to come in. This is a good one to watch. The short end's a good area to watch for where the market really sees rate cuts. If we start creeping back above 470, that'll be the market siding a little bit more hawkish about rate cuts, and maybe start underpricing the Fed instead of overpricing the Fed, as it has been. Gold, that's still waffling around the 2030 area. So again, we're back in no man's land. I should put a big zone in there with a big sign saying no man's land, because we sit in there and do nothing. But it's still holding its gains at least. This 2010-2000 area going to be important again. I think if we dip, or I'll be looking to see if it's important again on the way down. Commodities as well, as we mentioned, generally looking a bit more brighter. Oil not looking like it wants to bust out, but it's again, it's keeping its gains, just finding a bit of toughness coming up towards the highest 78s into 79s. Just have a quick look at some of the other commods around the ground. You might remember where I put them. Copper, lots of people keeping an eye on that one. Again, still looking fairly well bid. I'm wondering if China's a bit behind the commodity rise as well. Generally, they're just back from their new year. They've got to they've got to keep growth on track over there. One of the ways they do that is infrastructure. You want to go and build 100 motorways, that keeps GDP up. You need commodities for that. So that could be a reason they want to kick their new year off on the right foot, which is then obviously a boon for commodity currencies like the Aussie. I woke up this morning seeing Aussie dollar running high, so I decided to tip myself out of my short. I gave a little bit back. I was shorting against this level. I've got some off in the dips, not as much as I wanted to. I woke up, it was trading 73s. I thought, no, that's enough. I'm going to just throw it. So I got out of that, saved myself a few pips. But this is looking like a bit of a break now. But if it continues to pull back, I want to see what happens at this line. I'm not so keen to be long yen pairs at the moment, as I say, with that increased rhetoric from the Ministry of Finance. I think it's just there's a heightened risk that they do something. So I'm not really keen to be on the long side of pairs here. I am still a bit short dollar yen, but that needs to do something, or I'll chop that because it's just getting eaten away by the carry as usual. Kay, do you want to have a little look-see?
I'm just looking at the clock, Ryan. Do I show a couple of things, or shall we call it a day for today? Perhaps, but that would be for people who are watching emerging markets. Yesterday we had that South African budget, which had a bit of a move in the rand. Do you want me to show it, or?
Yeah, I'll limit you to two, and then I'll ring the bell.
Yeah, I mean, I'm just taking a minute to show this. So we've had this budget thing out yesterday, and the market was taking it very positively that South Africa wanted to use some of their reserves to pay and to keep the deficits low for the next 3 years. So at first, the market bought the South African rand on the back of it, right there, thinking they may have to sell some gold or sell some of their FX reserves. But we were talking about it in the room, especially with James, and we were talking about, like, say, this doesn't really feel right. So we had a bit of a discussion about that, and we decided to catch a knife here. And so that's what we did. We, in the meantime, ran back higher a bit. This morning, on the back of a lower dollar, it came back down. But dollar rand seems to have difficulties to stay lower. I don't think, and I don't see that there's too much positives to take out of this budget right now. And it seems the market is finally starting to come around to that idea as well. If confirmed, then I think we may have a visit back to the top end of this triangle sooner or later, and that's going to be somewhere in the 905, 910 zone, possibly even running higher if the dollar market turns around. For instance, on the US PMIs this afternoon, if they would come out and show us a higher number, that could do the trick for that. For the time being, we're still in the range, but it's encouraging for those who are long, at least. It's kind of encouraging that we are not holding those lows, let alone holding the lows and moving lower. Okay, so that is the thing I wanted to show. And then the last one, because there's always a lot of people asking about the cable. We are still in this triangle. Okay, we did move up to the 61.8 of the move that we saw from the end of last year into February. We moved up to the 61.8, but there's still 27.20 waiting above, and the top end of the shallow, what should I say, triangle around 127.40 to reckon with. For as long as we are in there, and Ryan is agreeing with that, I think, as well, because we talked about those ranges. You play the intra-range moves, and you don't go specifically look for breaks here or there. At least I won't. I'm finding it a bit useless to try breaks. I've played so many breaks in my life that it's at the end you just need to respect ranges until they really break. And that is it for now, really. Ryan, I'm giving it back to you, mate.
Yeah, thank you very much, mate. And yeah, I've just put a link in there for our chat room, because these guys yesterday, I'll just share the screen quickly so I can show you very quickly. Kay and the guys in there really nailed that. Let me see if I can find it first. I might not be able to find it exactly. Yeah, the guys in our room nailed that dollar rand move, that dip, all jumped on it. Let's see if I can show it in here. No, it's a bit garbled, I should say, all over the place.
I can show it because I have it in front of me. Oh, there we go.
Oh, really? Yeah. So yeah, this is a good thing about our community. You can have events like this, and someone pops up and says, yeah, they're not happy with what they're seeing the move. They don't agree with what the market's doing with that move. And all, you know, K-Man there as well, jumping in the 80s, 90s, 79s, piling in, and up it rallied into the 1890s. So, you know, there's these things not planned. You just look at one event, see a headline, and you don't agree with it, and you find the reasons why. And yeah, then it forms a trade, and off you go, and you nab another decent amount of pips. So yeah, that's a good reason why we have such a good community here. But can you see the screen?
Yeah, I can see it.
Yeah, I've got it. You can got it now. Cool. So yeah, that's a reason why the community is so good, because you can come in and you know, get a plan, find a trade out of nothing, and make some decent pips on it. So yeah, use code FFL20 if you want 20% off your sub for as long as you subscribe. You can have that discount. It's not just a 1 month, 2 month thing. And what we like to do at ForexAnalytix, if you're locked into a price, you keep that price for as long as you keep subscribing. We don't come and hit you with a price rise middle of the year like you do with your phone company or whatever. So yeah, we like we show you loyalty for being customers of us. And on that note, we should call it a day. Thank you very much for giving us your support for the Flow Show, your custom here. Thank you very much for Kay. Don't forget to check out his video. I think it's still there. And yeah, have a great day, everyone, and we'll see you tomorrow.
Cheers, guys.